know that over the past 90 years, the S&P 500 has delivered an average annual return of around 10%, outperforming most actively managed funds? Yet, many investors still miss out on this powerful wealth-building strategy. Let's talk about why index funds might be the most underrated investment vehicle out there. Stick with me for the next hour as we break down how you can leverage this simple, yet powerful, investment strategy. We'll explore the myths, the truths, and the practical steps you can take today to build your financial future. Welcome back to the channel. Today, we're diving deep into how to build a solid wealth foundation using only index funds. As investing becomes more accessible, more and more people are turning to index funds for their simplicity, low costs, and impressive returns. But can you really create lasting wealth this way? Let's find out together. Before we jump in, grab a notebook because we're going to cover everything from the basics to some advanced tips that could make a huge difference in your financial future. So sit back, relax, and let's start building that wealth. First, let's understand why indexed funds have become so popular. We'll touch on the history of indexed funds, their performance compared to active management, and why so many financial advisors recommend them for long-term investing. For many people, building wealth seems like an overwhelming challenge. The stock market can be volatile, unpredictable, and full of confusing choices. Should you invest in tech stocks, bonds, or maybe cryptocurrency? This complexity often scares people away from investing altogether or leads them to make costly mistakes. I totally understand how daunting it can feel. The fear of losing money, the constant news about market crashes, and the sheer volume of investment choices. But what if there was a simpler, more reliable approach? Let's break this down piece by piece. The emotional trap. Many investors buy high and sell low due to fear and greed. We'll talk about how index funds help you avoid this cycle. Market timing fallacy. Trying to time the market is almost impossible. I'll share some surprising stats on why staying invested beats timing the market. Over-diversification. While diversification is essential, owning too many individual stocks or actively managed funds can hurt your returns. Index funds strike the perfect balance. This is where index funds come in. An index fund is a type of mutual fund or ETF designed to track the performance of a specific market index, like the S&P 500 or the Nasdaq 100. Instead of trying to beat the market, these funds aim to match its returns, and over the long term, that strategy often wins. Let's break this down step by step. Diversification. By investing in hundreds or even thousands of companies, you reduce your risk compared to buying individual stocks. Think of it as not putting all your eggs in one basket. If one company underperforms, others in the index can balance it out. Low fees. Actively managed funds charge high fees that can eat away at your returns over time. Index funds typically have expense ratios below 0.1%, meaning more of your money stays invested and growing. Passive management. No need to constantly monitor the market. Set it and forget it. This also means fewer emotional decisions, which often lead to buying high and selling low. We'll go through each of these benefits in detail. I'll share some interesting historical data and a few charts to show just how much of a difference these small advantages can make over time. I'll also touch on why even professional investors often struggle to consistently outperform index funds. To make this even clearer, I'll show you a hypothetical portfolio of someone investing $500 per month, and we'll project how that grows over 10, 20, and 30 years. We'll also explore how adding an international index fund or a bond index fund could provide even more diversification and stability. Consider this. If you had invested just $500 per month into an S&P 500 index fund over the last 30 years, you'd have over $1 million today. And that's without needing to pick winning stocks or time the market. The power of compounding, combined with the stability of broad market diversification, makes this strategy incredibly compelling. But it gets even better. What if you increased your contributions by just 5% each year? That simple adjustment could add hundreds of thousands of dollars to your final portfolio. I'll take a few minutes to run through a compound interest calculator so you can see the math for yourself. We'll also talk about the psychological advantages of index investing, how it helps you stay calm during market downturns and stay focused on your long-term goals. This is the turning point. Understanding that time in the market is far more powerful than timing the market. I'll share a real-life success story of an average investor who achieved financial independence simply by consistently investing in index funds, through both bull and bear markets. So, what have we learned? Index funds offer a straightforward, low-cost, and historically proven way to build wealth over time. By staying consistent, avoiding emotional trading, and letting your money grow, you can create a solid financial foundation without the stress of active investing. Let's recap the key takeaways. Index funds provide diversification, reducing your investment risk. Low fees mean more of your money stays invested and compounding. Passive investing helps avoid costly emotional decisions. Consistency is the key. Small, regular investments add up to big results over time. Adjusting contributions gradually over time can supercharge your portfolio. I want to hear from you. Are you already investing in index funds, or are you considering starting? Let me know your thoughts in the comments below. And if you found this video helpful, don't forget to like, subscribe, and check out my other videos for more tips on building wealth and achieving financial freedom. Also, if you're interested in a step-by-step guide on how to set up your first index fund portfolio, drop a comment, and I'll make that my next video. Thanks for watching, and I'll see you next time.